Welcome back to Intelligent Investment Today, the podcast dedicated to cutting through market noise, hype, and speculation to focus on what truly matters in investing. Long-term value, strong fundamentals, and thoughtful decision-making, guided by the enduring principles of value investing set out by Benjamin Graham. Today's episode invites us to step away from stock tickers, price movements, and short-term forecasts, and instead focus on something far more fundamental. How great investors actually think. Not what they buy this quarter, or how they react to the latest headlines, but how they approach decisions when the future is uncertain and emotions run high. To explore this, we're turning our attention to one of the most influential minds in the history of investing, Charlie Munger. While Warren Buffett is often seen as the modern face of value investing, Buffett himself has repeatedly acknowledged that his evolution as an investor was deeply shaped by Munger. And not because Munger introduced complex formulas or sophisticated financial engineering, but because he brought a different way of thinking, one grounded in clarity, discipline, and a deep understanding of human behaviour. Charlie Munger believed that most investing mistakes are not caused by a lack of intelligence, but by poor judgment. He argued that people rely on too few ideas, approach problems from too narrow a perspective, and fall victim to predictable psychological traps. His solution was what he called a lattice work of mental models, a broad set of principles drawn from multiple disciplines that help investors see reality more clearly and avoid costly errors. In this episode, we're going to explore the mental models that Charlie Munger believed mattered most and why they fundamentally changed the way value investing is practiced today. These ideas are not about beating the market through clever tricks or constant activity. They're about avoiding big mistakes, improving decision-making, and positioning yourself to benefit from long-term compounding. By the end of this episode, you'll have a clearer understanding of why Munger placed such emphasis on temperament over intellect, why avoiding stupidity can be more powerful than seeking brilliance, can matter more than knowing more. So let's get right down to it. As ever, sit back, strap in, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. To begin, we need to understand why Charlie Munger believed that clear thinking and not prediction is the true edge in investing. Munger often said that the world is not driven by complex equations, but by simple forces acting repeatedly over time. One of the most important of these forces, in his view, was a tendency of people to make avoidable mistakes. He believed that success in investing did not require extraordinary brilliance, but rather the consistent avoidance of obvious errors. This belief led him to one of his most important ideas, inversion. Instead of asking how to succeed, Munger preferred to ask people how to fail. Instead of asking how to make money, he asked how money is most often lost. By approaching problems this way, many paths could be eliminated immediately. Excessive leverage, businesses that are impossible to understand, management teams with poor incentives, and industries with structurally weak economics were all places where investors regularly ran into trouble. Avoiding these areas didn't guarantee success, but it dramatically reduced the risk of permanent failure. Munger believed that avoiding big mistakes was far more important than making occasional brilliant decisions. This mindset stood in sharp contrast to the culture of constant action that dominates modern markets. Many investors feel pressure to always be doing something, always adjusting, always trading. Munger believed this urge often worked against long-term results. Closely related to inversion was his insistence on staying within one's circle of competence. Munger did not believe that intelligence alone could compensate for lack of understanding. In fact, he thought intelligence could be dangerous when combined with overconfidence. Your circle of competence, as Munger described it, consists of the businesses and industries you truly understand. And not because you've read a few reports or followed recent trends, but because you grasp how they generate cash, what their key risks are, and why customers continue to choose them over alternatives. He emphasised that the size of this circle is far less important than knowing its boundaries. Many investing failures occur when people stray outside their circle without realising it. They assume that because they are smart in one area, they must be smart in all areas. Markets have a way of punishing that assumption. This discipline explains why Munger and Buffett avoided many fashionable investments for decades. When they finally committed significant capital to companies like Apple, it was not because of excitement about technology, but because they understood the underlying business economics, customer loyalty, and brand strength. Another mental model that sat at the core of Munger's thinking was the power of incentives. Munger believed that incentives shape behaviour more reliably than ethics, intelligence, or experience. He famously remarked that if you want to understand outcomes, you should start by understanding incentives. In investing, this meant looking beyond what management said and focusing on how they were rewarded. Compensation structures, bonus targets, and promotion criteria often explained corporate behaviour far better than official statements or strategic plans. Munger observed that poorly designed incentives could lead even well-meaning people to act against shareholder interests. Excessive risk-taking, earnings manipulation, unnecessary acquisitions, and short-term decision-making often followed logically from incentive schemes that rewarded appearance over substance. By carefully analysing incentives, investors could avoid many traps that appeared attractive on the surface but were deeply flawed underneath. This approach required scepticism, patience, and a willingness to question popular narratives. Munger also placed great importance on second-order thinking. While many investors focused on immediate effects, Munger trained himself to consider what would happen next, and then what would happen after that. A business experiencing rapid growth might look attractive at first glance, but if that growth required heavy reinvestment or aggressive pricing, then long-term profitability could suffer. Low interest rates might boost asset prices in the short term, but they could also encourage speculative behaviour and weaken financial discipline. Second-order thinking required slowing down and resisting simple conclusions. It required imagining multiple possible outcomes and considering unintended consequences. This habit of thought helped Munger avoid fads and remain grounded when markets became euphoric or fearful. Opportunity cost was another concept Munger believed most investors failed to appreciate. Every dollar invested in one opportunity is a dollar that cannot be invested elsewhere. The question, in Munger's view, was never whether an investment was good, but whether it was the best available use of capital. This belief explained Berkshire Hathaway's willingness to hold large amounts of cash for extended periods. Cash was not seen as wasted potential, but as flexibility. It allowed the company to act decisively when rare, high-quality opportunities appeared. Munger understood that great investments are uncommon. Forcing action in mediocre situations often leads to disappointment. Waiting, though emotionally difficult, can be a powerful strategy when combined with discipline and preparation. Underlying all these ideas was Munger's deep understanding of human psychology. He believed that psychological biases were responsible for more investment errors than lack of information or technical skill. Overconfidence, social pressure, confirmation bias, envy, and fear all played powerful roles in shaping investor behaviour. Markets, in Munger's view, were environments where these biases were constantly tested. Prices moved not just in response to fundamentals, but to emotions. The ability to remain rational when others were panicking or chasing trends was a significant advantage. For this reason, Munger emphasised temperament over intellect. He believed that a calm, patient investor with average intelligence would outperform a brilliant but undisciplined one over time. Emotional control, humility, and self-awareness were traits he valued more than analytical brilliance. When viewed together, Charlie Munger's mental models form a coherent philosophy rather than a checklist. They are designed to improve judgment, reduce error, and align decisions with reality. They do not promise quick gains or easy answers. Instead, they emphasised durability, consistency, and long-term thinking. Munger's influence on Warren Buffett transformed not just individual investment decisions, but the entire approach of Berkshire Hathaway. The focus shifted from buying statistically cheap stocks to owning exceptional businesses. Perhaps Munger's greatest contribution was reinforcing the idea that investing is not about predicting the future. It is about preparing for uncertainty. It is about making decisions that do not require perfect foresight to succeed. By avoiding obvious mistakes, staying within one's own competence, understanding incentives, thinking through consequences, and maintaining emotional discipline, investors can tilt the odds in their favour without needing to outsmart the market. Munger showed that wisdom, not cleverness, is the true foundation of long-term investment success. His ideas remind us that progress often comes not from doing more, but from doing less, better, and with greater intention. And that is all for this edition of Intelligent Investment Today. I do hope you've enjoyed taking a deep dive into Charlie Munger's financial toolbox, and the lessons learned can be applied to your own portfolio and outlook. If you have enjoyed it, you know what you can do. Hit that subscribe button or add to playlist so you need never miss a future edition. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.